Very pleased to welcome back to the show Tyler Bullhorn, and you can find him at stockscores.com. Tyler, great to have you with us again here. And I just was recalling when I, a couple of days ago, and I was thinking you were coming on the show. That's just a little reminder of how you got started. I think you were 19 or something.
Yeah, I was 19 years old, student at the University of Calgary, and I decided I wanted to pay my way through school with the stock market. So I borrowed some money off of my credit card and bought my first stock. Probably not the best way, a little bit risky, but when you're young, what the heck, hey?
Yeah. Well, it certainly turned out pretty well. I mean, one of the things that I love about our business, one of the things I love about our business is, and this is what's missing, I think, in so much political discourse, is nothing like losing or making money to really focus the mind and to learn, to learn lessons very clearly when you've been on the losing end of a trade.
Yeah, that's right. And my first trade was a loser, but I just loved the stock market and the concept of the market, and I stuck with it. It wasn't easy, I would say, getting started. It took time, but, I didn't approach it in a normal way. I sort of threw out what I was being taught in my finance classes, and I kind of reverse engineered the stock market and sort of looked at what were the stocks that were doing well and what were their characteristics early in their upward trend, and sort of worked backwards that way and discovered some things that I still use to this day, actually.
It's interesting, as you say, you develop tools and then you adjust the tools, et cetera, et cetera. Maybe give us a hint of the first breakthrough you had.
I was taking a class in university where we looked at mergers and acquisitions in the 90s and 80s, and it was all about whether there was insider trading activity in these stocks before a big deal was announced. So when, R.J. Reynolds bought Nabisco, was there evidence in the market that someone knew that deal was coming? And we found over and over and over again that the stock market trading activity showed that someone had better information than others and was trading on that information. And that little, 1 hour class really is the basis of everything I do today. I look for statistically significant abnormal trading activity to tell me that something fundamentally is going on at that company. But because the market isn't always fair, you don't learn about what it is until later. You just react to the market today.
It's one of those things, though, and I know you must face this challenge all the time, is that people understand that and they say, but can you just do it for me? I can't do that myself.
Yeah, and I have lots of people say, can you do this for me? I'm not a licensed investment advisor, so I don't manage money for people. I think what's important is to learn how to do it yourself, because you have to understand the reason why you take these trades so that you know when to exit them. And it's not really that difficult. It takes a little bit of time and effort to learn, but it's a lot of fun, I think. And once you learn it, you're armed with this skill that you can carry with you for life and really start to harness the investment potential of the market without being complex about it. It's some simple rules that you follow, good risk management, knowing where the action is, that kind of thing. You're armed with these simple things. Even if you have someone managing your money for you, at least you're educated in what they're doing.
Okay, I promised earlier on that you were going to come on. We're going to talk about specific ways to improve all of our stock market profitability in this year. And so what about it? Let's start with a couple of hints here, how we can all be better at this.
Yeah, so I've got my 5 ways to improve your stock market profitability for 2017. The first one is listen to the market. I follow this guy on Twitter. I'm going to use this example. I won't name him because it's not fair, but he is a very smart, well-informed person. He presents compelling arguments over and over again about why the bull market is going to end. And for 5 years, he has been dead wrong. The problem is, unless you focus on the thing that everyone else is focused on, you can be wrong. And so my first rule is listen to the market. You can have an idea. Let's say someone says to you, I think gold is going to go higher. Great. But look for the proof in the market that the rest of the world agrees with that idea. And if the idea isn't confirmed by trading action, if someone says, the gold industry is great, well, if gold is going down day after day, then ignore the idea until the market starts to prove it correct. So many people have called this bull market destined to fail, and there's a huge correction coming. And yet week after week, month after month, it's in an uptrend. And so why fight it? Just follow the trend and let it make you money.
Well, it's interesting. I was just talking with Jill Bennett earlier today before the program began, and talking about this difference between your opinion and sort of reality. You know, like I was trying to explain it in this way, as I said, you know, I know my opinion is unimportant. My opinion has been every stock I ever bought should have gone up. It didn't quite work out that way. And that's what you're alluding to here. I think this is a very important thing that you're saying, because I've seen it a lot with gold would be another great example because it's well followed, and people thinking, well, there's geopolitical events going on, you know, the central banks are printing like crazy. Well, that's been a disappointing trade since 2012. Simply, I mean, because if you observe the market, you'd see that the money kept going to the U.S. dollar when all of those events kind of reared their head. And we are still waiting for when gold shows us in the market that it's its turn.
That's right. And, you know, gold has had a little bit of a bounce since the middle of December, but it's coming into an important downward trend line, and I'm starting to hear the gold bugs cheering because they've made some good money over the last 6 weeks. But you got to be really careful because the trend for gold is still down in the long term. Short term, up, but, you know, treat it as a trade at this point because we're not yet out of the woods on gold.
Let's come back to the stock market itself. So if you're using what you're just saying, let's have a look at the broad markets, and you can pick which one, whether it's the TSX or, you know, Dow, etc. I mean, it seems a pretty clear message, despite all the talk about Donald Trump, et cetera, that it's in a strong uptrend.
That's exactly right. And, you know, the market always focuses on one or two things. Last year, the number one focus was what is the U.S. Fed going to do with interest rates? The last Fed meeting was a ghost town. Nobody cared about what was happening. Now it's all about when is Trump going to say something crazy? Is he going to do this tax revision plan that's going to allow companies like Apple Computer to bring all that cash that they have offshore, you know, over $200 billion, bring that back and add shareholder value that way? And the top performing stocks are companies that benefit from Trump, Goldman Sachs, Apple Computer. Many of the stocks in the market actually aren't doing that well, not as well as the index, but the index is in an uptrend. Ignore all the naysayers, just follow the trend, and the trend is up.
Okay, so summarize the first rule, just watch the market. It'll tell you what's going on.
Listen to the market, let it tell you what to do. That takes 5 minutes a week. You know, print off a chart of the market, take out a ruler, draw a line across the bottoms. If it's going up from left to right, you have a bull market.
Yeah. Okay, let's get to number two. Second way we can put on our arsenal here.
Sure. Number two is don't take more risk than you can tolerate. You know, we humans are emotional. We have an emotional attachment to our money, and our judgment carries with it a lot of bias because of that emotional attachment to money. So I think that another important thing, and I see people make this mistake all the time, is they take on too much risk in an individual stock. They'll, you know, hear a great story about a $1 mining stock that's supposed to go to 10, and they put a lot of risk in it. And then when the market tells them that the story isn't so great, they can't sell it because they can't stomach the loss. And so I always tell my students, capital preservation is your number one goal. Don't take too much risk on any one thing. And the ultimate rule is, can you sleep well at night with the stocks that you own?
That reminds me of an old Bernard Baruch saying when he said, if you don't know who you are, the stock market's an expensive place to find out. Because when you're talking about that, about taking too much risk, I'm nodding. I mean, I found out the hard way that I just don't have the emotional makeup to be a trader. I'd have to have a very small amount of money. I certainly couldn't do it broadly like Victor does, for example. You know, so you have to just know yourself, as you say. And for me, it was taking on positions that added too much risk to my own psyche.
That's absolutely right. Yeah, you have to trade for your personality.
I got Tyler Ballhorn in the this is great stuff on the line with me right now. Stockscores.com. Tyler tours the country giving talks. He's been a very good friend of us here on Money Talks. Author, also a tremendous amount of training courses too. And you can go to stockscores.com. But I got to take a break at this point. I'm going to come back. He gave us a couple of little hints here. I'm going to get a few more from him when we come back right on the Money Talks Network. You're listening to Money Talks. I hope you were with me last weekend for the Outlook Conference. I really thought it was spectacular. Some tremendous information there. I'll tell you, everyone was buzzing when Jim Dines starts talking about uranium, or he starts talking about the performance that he sees forthcoming in silver. You can throw on then interviews with Martin Armstrong. Always fascinating to hear him. Joseph Schachter gave a very specific blueprint for oil prices. And Ryan Irvine, of course, his small cap portfolio. the new one for 2017 after a very successful 2016. I bet he's off to a roaring start, by the way, right now, the way the markets have been. But there's a lot of stuff there. And if you missed it for some reason, don't worry. You can still go and you can get it right away almost instantly. If you go to moneytalks.net, you can still click on and get the World Outlook Conference videos and access them immediately. And then you can hear what Tyler's got to say with his Tyler Bullhorn and make sure you apply it in the right way, some of that information. Tyler, just before the break, I was thinking to myself, there's an old expression by Dan Millman. He wrote The Peaceful Warrior and The Warrior Athlete that became quite popular books. But he always had this nice little expression. He said, there's only 7 lessons to learn in the universe. The challenge is, how often do you have to learn them? Well, as I say, unfortunately, because of the scorecard so clear, did I ever have to nod my head when I heard that? And I hate to think of how many times I've learned the lessons that you're just sharing with us right now. So let's get on to another one.
All right, so my third one is really the secret to finding hot stocks. That's, unless we're just trying to collect dividends or something, if we're investing in the market, we want to find those stocks that do better than the market. And they almost always have the same footprints. Stocks that ultimately outperform the market begin their upward trends with abnormal trading activity, stronger volume than normal, and more price volatility than normal. So if you can imagine a stock kind of meanders between $4 and $5 and trades 1 million shares a day, then one day jumps up to 6, big jump in price and trades huge volume. There's a reason for that. There is some significant fundamental change underway, and the people that follow the company the closest, that know it really well, they will act aggressively in the market when they learn of that new fundamental change. And the market then starts a trend as more and more people learn. They buy the stock and it goes into an upward trend. So my third rule is follow abnormal trading activity. It's huge.
Okay, and again, so you're looking at the charts. It's straightforward. You look at changes in volume and price.
You want to see, really what I like to see is a stock that nobody cares about, that's just kind of meandering sideways, and then it has a pop in price, whatever that pop is relative to its history, it stands out, and it trades much more volume than normal. It's basically, there's a party starting. There's people screaming, hey, look at this stock. There's something fundamental going on here that we like. Now, what's key, though, is you have to do that early in an upward trend, not after it's been going up for months already. You want to catch that when it's just starting to come out of boredom.
And by the way, this is such a key thing that you do for people, and you've outlined in your book and in your courses, because isn't it the tendency, we're risk averse, or many of us are risk averse, so we actually wait till the horse race is almost finished before we want to place our bet, as opposed to you're identifying which horses are going to win very early from looking at the price action and the volume action, which is anyone can do.
Right, and it's a simple thing to do, but human beings, we learn from our past. And so what happens if we touch a hot stove, we know in the future don't touch a hot stove. We kind of wait with things to prove themselves. If I told you today, go buy ABC Mining Company, you'd probably doubt me, and only when it has started to do well that I've proven me to be correct, you would believe me. But by that time, it's too late. You're buying the reward, not taking the risk. And so it's key to find these things when they're just starting to move with that abnormal activity, and then let them run, which will be rule number 4.
Okay, well, give us the last one there, because you promised 5 ways to improve our stock market profitability this year, and you've given us 4 great ones to begin.
Okay, well, the 4th one is actually be patient with your winners. Let those winners run. When you have a winner, let it go. Tech Cominco last year, Tech, TECK.B, top performing big large cap stock on the TSX. It went from $5 to $35 in the year. If you didn't have patience with that winner, you don't let it run, and it doesn't pay for your losers. And that's the 5th one, is have no patience with your losers. If you buy a stock and it falls down through a floor price, and we can describe how that works, you got to cut it loose. You're not going to be right all the time. Investing in the stock market is a sort of a numbers game, and you got to let your winners run and stop your losses short.
Well, come back to the losses for a second, because I think one of the challenges people have, whether they've got a winner on their hands, and I think even worse when they've got a loser, is when to get out of them.
Right. So here's a simple thing, and it makes a little more sense visually, but I'll describe it as best I can. If you're looking at a stock and you look at, its low price over the last month, let's say over the last month the stock has traded no less than $9. What the market's really telling you is that based on all the fundamental information that investors have, they don't think that that company is worth less than $9. And so it's established a floor. Well, if it were to go below $9, it implies that some new information has come out that justifies taking a lower price. So anytime I buy a stock, I look at the floor before my buy signal. If the floor is $9 and I say, well, if it goes down to $8.90, I'm going to cut out because something is wrong. And you should do that for every stock that you buy. Always know where the exit price is based on what the market has told you from the past.
Well, and as I say, I think that's one of the biggest challenges. Maybe I'm talking about myself here and why I said I wasn't a trader, but it's something that I think everyone can share. Tyler, I want to thank you for finding time for us again. You're always a great friend of the show, but such valuable information. And for more, you can go to stockscores.com. And if you get the chance to hear Tyler speak, you want to take him up on that. Stockscores.com, Tyler Bullhorn. Tyler, thanks for taking the time.
Hey, great to be with you. Have a great rest of the weekend.